There are basically two different kinds of investors: those who value companies based on some sort of methodology, and those who engage in momentum or psychological trading and try to predict the behavior of crowds. The reality is that the behavior of the crowd dominates any market, and if you're able to predict the behavior of the crowd, you'll have good performance, because the crowd's behavior determines the price in the short term. The value trader also sees the crowd, but also asks, what is the crowd seeing? Sometimes the crowd is right, and sometimes the crowd is wrong. When there is a deviation between what the crowd sees and what the company is really worth, you are set up for either a long or short trade based upon valuation. Warren Buffett is the most famous student of Ben Graham, who is the first to map out the ground rules of value investing. Value investors make judgments about whether to buy or sell a company's equity by qualifying the company's intrinsic value through analysis and understanding a company's intrinsic value may or may not be properly reflected in its market cap. Ben Graham is also famous for figuring out a strategy of near riskless arbitrage, primarily through the purchase of high-yield convertible bonds while simultaneously shorting the same company's common stock, or through the purchase of puts, which worked out to essentially keeping the bonds yield for free. But Ben Graham is most famous for his illustration of Mr. Market, which goes back to Ben Graham's book, The Intelligent Investor, that was first published in 1949. In his book, Graham, who first invented fundamental analysis, did two things for the intelligent investor. First, he emphasized that owning shares of a stock is like owning a piece of the business, and the intelligent investor should never overpay for their piece of the business. Secondly, Graham introduced an enormously valuable analogy of the market he called Mr. Market. Mr. Market is every investor and trader's silent partner. On some days, Mr. Market is optimistic and willing to pay almost anything for what you have. On those days, Graham says the intelligent investor should sell to Mr. Market. On other days, Mr. Market is extremely depressed and wants to sell everything he has at whatever price people are willing to pay. On days Mr. Market is depressed, Graham says the intelligent investor should buy. Other days, Mr. Market is neither depressed or optimistic, and on those days, Graham says you shouldn't do any business with Mr. Market, because the day will soon come when Mr. Market will pay you anything for what you have, or be willing to squander what he has by selling to you at a very low price. Even as Mr. Market is alternatively hot and cold, the intelligent long-term investor should maintain their investment vision and shouldn't get caught up in Mr. Market's depression or optimism. Knowing a little bit about Mr. Market when you hear a talking head on TV say that Mr. Market is optimistic can inform the intelligent investor that a pile of people are selling into strength. Alternatively, when Mr. Market is depressed, the intelligent investor is likely to be a buyer, even as the market may be falling, because they know that soon enough Mr. Market will be stupidly optimistic again and offer nearly anything for their stock in the company. Knowing this, I suggest that you
throw your hands up, take it to another level, and you never ever ever make a deal with the devil.